Welcome back to the channel, guys. Today we're going to learn about the average true range indicator and how we can properly utilize this tool in our technical analysis to achieve better trading results. So let's begin. The main goal of the average true range indicator, or ATR, is to measure volatility, but unlike other similar indicators which consider only daily highs and lows when calculating volatility, this particular indicator adds two pieces of price information into the equation. These are gaps and limit moves. Gaps are basically spaces on charts that are created when a significant price change occurs with little or no trading taking place. Limit move, on the other hand, is the maximum amount of price change that is allowed for a commodity futures contract to undergo, determined by an exchange. The inclusion of both of this important data enhances the ability of the ATR to display more correct values. This is why ATR is very good at showing more realistic data when it comes to volatility. Let me show you why this is a big deal. To make it easier to understand, let's focus on gaps. Imagine a scenario when a stock XYZ closed at $10 per share on Friday. Let's assume that on the next Monday it gaps up and opens up at $11.50. The daily high and the low recorded on Monday are $11.75 and $11.45 respectively. If we don't include the gap that occurred on Monday because of some news that changed the sentiment over the weekend, the daily volatility range would be only 30 cents. As you can see, this can be very deceiving if we don't count the higher opening price. ATR fixes this by including the gaps in the calculation and does provide more accurate volatility data. In our case, the real value would be 175. Nowadays, we don't really have to worry about how the ATR is calculated because the charting softwares will do this job automatically for us. However, for those interested, I can briefly explain how it's done. Following is the formula of how ATR is calculated. ATR stands for average true range. N stands for number of periods considered. The popular choice is usually 14. TR is the current true range. TR is basically the largest absolute number. It is usually selected out of three numbers that result from doing the following calculations. The first, today's recorded high minus the low. The second, the absolute value of today's high minus yesterday's close. The third, the absolute value of today's low minus yesterday's close. Based on the data from the example I gave you earlier, let's calculate the current true range. In our case, the following are the results. As you can see, out of all the three numbers, 175 is the greatest. Therefore, this number will be used as the current TR. Now, all you have to do is insert the numbers in the formula and you should get the value that you're looking for. Like I said before, you shouldn't really worry about doing this math because charting softwares will do this automatically. So the next logical question you might ask is what the ATR is primarily used for. Glad you asked, because I'm gonna give you the detailed explanation of how this tool can benefit you in your trading analysis. One thing to note is that ATR itself does not give traders directional signals like other indicators such as RSI or MACD would. Instead, it provides a good indication of whether the market is in a risk-on or risk-off environment. This is especially true when it comes to market reversals. To be clear, a risk-on situation usually happens during a bullish market environment, while risk-off during a bearish one. As a general rule, ATR usually starts to increase dramatically during the beginning of a genuine downtrend once the institutional players start getting involved. This is logical because these guys can move markets with large orders. The end result is obviously a market environment where volatility becomes very high. Therefore, what retail traders can do in this situation is to watch for a big spike in ATR and see if this action takes place while the price is inside or near a good resistance area. If this is the case, then shorting either on a breakout to the downside or on a retracement back to a resistance area would be an ideal strategy. Bullish reversals, on the other hand, gradually decrease volatility. This is due to the fact that fear and panic in the markets start to subside. This usually causes ATR to start dropping, which acts as a further confirmation that bulls are taking control now. If you see volatility dropping and the price starting to go sideways after an extensive downtrend price action, then this can be a signal that a bullish reversal might happen soon or it's already happening. In this scenario, if the price is near a good support area, then preparing to go long on a breakout to the upside or on a pullback into a newly established support area is the best move. For a more accurate analysis, it's always good to use an extra indicator such as MACD or RSI in conjunction with ATR to further validate the outcome of the analysis. Speaking of the ATR readings, the indicator does not display values based on the percentage moves. What this means is the higher value stocks will have higher ATR numbers compared to the lower valued ones. Therefore, a comparison should be made with the previous ATR numbers of the same stock. Let me show you what I mean by this. Take a look at the following two examples. As you can see, there's no standard value that you can use to gauge the level of volatility. Every instrument will have different ATR numbers based primarily on the price of the stock. Therefore, to see whether a stock has a high volatility or not, you have to compare the current values to the older ones that were recorded in the previous trading sessions. When it comes to sideways markets, similar tactics can be used in both uptrends and downtrends. While the large ATR numbers show fear and high volatility, low numbers on the other hand indicate indecision, which often results in volume being very low. In this scenario, price usually stays in a sideways trend for a while. Similar to how Bollinger Band squeeze works, ATR will start to increase once a breakout either to upside or downside occurs. Traders who patiently wait for the move to happen can monitor ATR to initiate positions the moment the breakout occurs. The sudden change in ATR is usually very noticeable, therefore this is an excellent tactic to use if breakout trading is one of your favorite strategies. Now, we all know that trading very high volatility stocks can have a devastating impact on our portfolios. Therefore, it is highly advisable to trade or invest in stocks that have a good but at the same time manageable amount of volatility. There's a reason why many professional traders avoid dealing with penny stocks, for example. Many of them have extremely high volatility. Although the profits can be astronomical if lucky, the losses can be devastating as well. Therefore, using the ATR as a screener to weed out unnecessarily volatile instruments can help traders find good stocks that have ideal volume and volatility. It is important because volatile stocks can move fast and also can have large gaps. This in turn can jeopardize our risk management strategy. This is especially true for beginner traders who are just starting out and have not yet built the tolerance needed to deal with large losses. Therefore, using the indicator as a screening tool is highly advisable. This will let you find ideal stocks to trade based on your parameters that are acceptable for your particular trading strategy. Speaking of risk, another major reason you would want to use this indicator when setting up a trade is to calculate the proper position size for each of your trades. When it comes to trading with real money, it is very important to know in advance how much you're going to risk per transaction. This is done by calculating how many shares you should buy or short so that the risk amount does not exceed the dollar amount specified in your trading plan. However, determining the risk by only calculating the number of shares to come up with the right amount is not good enough. You need to incorporate ATR into the equation because some stocks' prices can fluctuate significantly more compared to the price of others. This in turn can result in many unnecessary stop outs if you're not careful. To prevent this from happening, it's always advisable to check the indicator for the daily ranges. Based on these ATR data, we can determine how wide or narrow our stops should be. For example, a $100 financial stock can have a price fluctuation range of 50 cents a day on average, while another similarly priced technology stock can have $2 range. If our maximum allowed stop loss is $100 per trade, then using the ATR, we can safely buy 200 shares in the first case and 50 shares in the second scenario. This is based on the premise that our risk limit rule is set to use 1 times the daily ATR reading. I hope you see how efficiently we can manage our risk using the ATR indicator, regardless of how volatile a stock can be. The situation I just described is especially relevant for a trader who likes a balanced approach when it comes to managing risk to reward ratio. However, there are also other scenarios which involve traders who have different risk tolerance levels. I'm talking about psychology and emotions. Some are very aggressive and can deal with the fast-moving markets without any issues. Day traders, for example. Others are more risk-averse and prefer less involvement in the markets. These are mostly swing traders and investors. Let me explain how people using these two different types of trading styles can also utilize ATR to properly manage risk. Let's assume that our predetermined risk amount per trade is still the same $100, but the daily ATR is now $1. For an aggressive trader using stops, their 50% of the daily ATR value can be a good strategy. Now the risk is still going to be $100, but the number of shares will increase due to our choice of using 50% of the daily ATR value. This aggressive setup is usually done on a smaller time frame chart. For example, instead of using daily candlesticks, a trader can decide to go with smaller support and resistance zone on an hourly chart to determine where to place the stop. This procedure still has to be done inside the daily support area to achieve the best results. Obviously, the possibility of being stopped out early will be a big risk. However, the potential to make more money is greater, provided the target price will still be the same one based on the daily chart. In this scenario, the profit can double because instead of purchasing 100 shares, the aggressive trader can now buy 200. For a risk-averse person, using wider stops can be a great strategy. In this scenario, one can use 2 times or even 3 times the daily ATR value to determine the stop. This will obviously reduce the profit potential because there will be less shares involved in the trade. This strategy is very popular with swing traders who will hold positions much longer compared to what day traders usually do. Day traders would never carry a position overnight. Now, long-term traders and investors can also choose to use weekly ATR instead of the daily one for the purpose of determining the risk parameters. However, placing stops and picking entry points using daily ATR inside our weekly support or resistance area is a much more efficient method to optimize the reward to risk ratio. Obviously, if you prefer to hold positions for years or even a decade, then using weekly ATR is totally fine. As you can see, ATR can be a powerful indicator that not only helps traders manage risk, but also acts as a confirmation tool that helps traders spot genuine price moves in the markets. I hope you enjoyed this lesson and learned a lot about the advantages of using the ATR. In the next video, we will be discussing another popular indicator called CCI, or the Commodity Channel Index. But until then, thank you guys for watching and I will see you next time. Cheers!